I think I would just start since your time is valuable. Let's kick off. So as I said, just send sort of quickly your decks to me, Felix at oysterbay.vc, if you want me to do live feedback on it. The way we structured the session last time was quite good. So basically, while I'm picking a deck, you send all your questions here in the chat. Basically, your questions you want to ask. Take your time, put them into the chat so that we can sort of do two things. I will do one live feedback on one deck, just sort of how do I actually review a deck? What do I see? What do I think? How do I look at it? I will do it in real life speed. So you also see sort of how little time VCs spend on decks, which is quite frustrating for most people, but I think it's honest and important to show. And then once we've done that, I'll go through the questions in the chat, see which ones I answer, and then we can do a bit more open discussion about some of these topics. And if we're a smaller group today, I actually really like it because it means we can do it. Let's start this. All right. So now I would say just throw all your questions in the chat, and then I'll go through them. I think that's easiest, and then we can jump into a live conversation as well. First question here from Comfort Magnus. Comfort's your first name? All right, cool. How to do product tests for customers, especially in food and beverage, because consumers and customers risk they need a okay. And as a very new startup, how do I show track record or impact of my business when at the pilot and MVP stage? So I think the first question is product tests. It really depends on obviously what you're doing. If you're doing a traditional like CPG product, I think the answer is quite easy actually. It's really what I did in my second company is really we just did formulations in our kitchen and then ran out on the street and we did blind tastings with 20 people. And I think it's just getting it out there and getting feedback as quickly as possible. It's not super unique advice, I would say, but I think that's how I would do it. It's a lot tougher if it's a very technical product, obviously, and it requires a lot more investment to actually do it. I found the barrier to entry actually quite low on a lot of these. I actually find it quite easy to get it done. If it's a novel food product, that changes the conversation quite a bit on what you can actually test and what you can do. So I think it really depends on your product, but I would just say consumers scored on the street, you can meet them. So that's quite easy. And real customers, I think from my view, if you're solving a real problem for them, I've found a lot of people just willing to take a first meeting. And I think nowadays getting access to these people is easier than ever. So actually like just getting into those meetings, into those rooms and getting people to give you real feedback is quite valuable. I would say that the art is really asking for the critical feedback because humans are nice and they don't want to hurt your feelings. It's uncomfortable, right? It's already uncomfortable for me to give like negative feedback on a pitch deck in front of so many people because like socially we're not, if you're not a psychopath, you're not wired that way. And for me, it's quite difficult to do that. So I think if you're giving your product to people to test, you need to ask them specifically, like, what can we improve? Like you need to frame it in a way where they're willing to give you negative feedback and make it socially acceptable that you actually get the real feedback and not the nice feedback because you're standing in front of them and they don't want to hurt your feelings. I think that's the real art of like asking for feedback in a way where you actually get the real answer. And then as a very new startup, how do I show track records of impact of my business? I think, again, anything, like it's not a formula in terms of like, this is the one thing we want to see as an investor. I think it's about like, how real is your traction? And if you're building something, I mean, we invested in a like harvesting robotics company at pre-seed when there was really pretty much nothing, but just based on what they had done in a few months, we had conviction that they could actually execute on this. So it's about like showing your speed of execution, and anything that shows that is a proof of traction. I think that's how I would answer that question. Then I think moving to the next question, if the startup's core asset is a data network that compounds over time, how should founders think about cap table structure and early dilution? I think the problem is the same for every company. I think especially if you're building something that's more tech heavy, CapEx heavy, like robotics, like two-sided marketplaces, those kind of things. Obviously dilution upfront is painful. And yeah, I think like there's a index, I think has a good model on their website in terms of what are standard dilutions and so forth. The way we think about it is we want founders to have 80+% after the pre-seed, 70+% after the seed, 50+% after the Series A. And that is usually doable in pretty much all industries. It's a negotiation then. But if you, like, I mean, the robotics companies come to mind or some other deep tech companies in our portfolio where the value is coming in 5 to 10 years. And it's just going to take that time. But then if we have conviction on this, on the size of the problem, then we don't have a problem to underwrite that risk and to invest, I would say. Very early, including seed stage commercial tractions, ask what startup should have to attract VCs at an early stage without yet LOIs and commercial contracts. I think it really depends on when you want to raise from a VC or when do you need to raise from a VC. I think VC money is expensive money. It's dilution. It's all of those things. So I think if you really don't have any traction, I think it's sort of it's what I said earlier, like how do you show speed of execution and how do you show that you're the right team to solve this problem? I think that's really, really key. But it's also something that we see quite like the unfair advantage that we sometimes have is we see like 8 companies doing the same things. And so we can actually compare speed of execution. And that is sometimes a differentiating factor where you see like 8 companies in the same space building the same thing. And you see one team having raised a lot, getting somewhere, and you see one team having raised pretty much nothing, getting further on less. And so, yeah, I think that is really differentiating yourself by showing that traction. I know it's a non-answer. Still, yeah. All right. Next one, cap table discussion ongoing. University spin on cap table is already seen as broken on ever. I mean, obviously I know your company, so I think I can answer this a bit more specifically. How do investors typically view this in later rounds, and what can be done to make sure the cap table company remains investable while also keeping the active founding team properly incentivized over time? So I think the answer is we as investors, we don't have a problem re-incentivizing founders. I mean, we just did an investment where we did that, created huge, actually quite significant option pool for the founders, diluted the existing investors quite heavily. So it's painful for the existing cap table, but usually as a founder, you have much more leverage than you think over your existing cap table. Because basically, I mean, you need to raise the next round. And your university in your cap table is not going to raise the next round. They're not going to put more money in. They're not. And so their stake is worth nothing without your work. So realizing that leverage is quite important. And then the question is more of a like, do you have someone who plays a bad cop who basically says, okay, this round will happen, but it will only happen if this is the way the cap table looks after the round. And we don't have a problem being that bad cop if we have conviction, but some other funds do. They don't want to do it. It's a hassle. So it's also something you can do before the round. Then obviously it's much more tension for you with your existing shareholders. But it is, in my mind, worth going through that pain as early as possible and fixing it as early as possible, because otherwise it's going to be a topic at every round. And rather do it once, really make it clear also for yourself that it's like a condition of you continuing, cleaning up that cap table, and then sort of you never have to deal with it again going forward. I think that's quite important.
So the answer is more like trying to find, for us to find the correct investor, I would say, as well as also doing the homework for itself, of course. But
yeah, or going to your existing cap table now and saying, hey, this is the feedback we got from investors. The cap table is not investable. We need to fix it now, and then we go out fundraising. That could also be a way to do it. That obviously creates a standoff, and it's a question of, do you have, like, who's the counterparty, right? How much do they understand about the startup game, blah, blah, blah. I think it's quite case specific, but usually founders underestimate the leverage they have over their cap table because it's worth nothing without your work. Like, that's the honest truth. And so I think, like, founders don't play hardball on these topics enough, I think. So I think it's something to be quite confident on, kind and confident, and hard on the negotiation line, I would say. That's a very clear how I would phrase it. All right. What's the sharpest reverse DD question a founder has ever asked you, and one that has actually made you pause? That's a good one. I would say in general, founders don't ask enough hard, like reverse DD questions. I think that's sort of something most founders should do more of. I, as a founder, didn't, and I think it's a good question. So I fully agree with that. I think the best founder actually asked for introductions to all of the companies that we had to write off. I think that was a good reference. Like he just asked for, can I speak to the companies you've written off to hear about how you handled that? I think that's a good thing to do, because when shit hits the fan, that's when character shows. So I think that's a very smart thing to do. And thankfully for us, we're happy to make those introductions. We don't have anything to hide. So I think that's but that's, I think, a very good question to ask. Can I speak to a couple of companies you've written off? Because I've also seen other funds actually then not, they stop showing up for board meetings. If it's not their winner in their portfolio, then they just stop coming. And I think that's also not what you want. So I think that's a good question. And how do you actually assess founder capability beyond the obvious signals like prior founder experience and exits? Yeah, that's the toughest question we have for us. And the real answer is this sort of Daniel Kahneman thinking fast, thinking slow system, where it's as humans, we're wired to find someone likable and capable with this fast thinking, like system one. It's this gut feeling. It's this very quick first impression within 2 seconds, right? And then everything else that happens afterwards is rationalizing that first impression. That's the reality. That's what the science tells us about assessing people. And so my job, or our job here, is we're trying to challenge our system one in a way of are we really is this really giving us the right signals? Because obviously there's a lot of bias in those system ones. And so it's a bit more about who's on our investment team and what are their backgrounds, such that we have diverse views on the people that we're meeting, so that we actually get a view of what's the reality. That's, I think, first part of the question, first part of the answer for us. And then so far, I haven't found any predictable, real predictable sort of test for founder quality. There's a couple of funds that do these intelligence tests and those kind of things. But every time I've looked at the data, it's spurious, to say the least. So I don't think we have a good answer. We do a lot of reference checks. We do 5, 6, 7 reference calls on each founder. So sometimes if we have a company with 3 founders, with all the customer calls, sometimes we do 35 reference checks in a due diligence. I think that's part of it, but it's not a perfect answer. I don't think it's an art more than a science, for sure. And we're quite humble about our limitations there. We'll never get it right. We'll for sure miss people, and we'll for sure make wrong decisions there. All right. Just looking at next question. Maya, it's your question about how much traction you need for pre-seed. I think if you have a couple of customers confirming that what you're building is valuable to them, that's enough for pre-seed. I think that's actually quite good for a pre-seed. I think on the topic that you are working on, the challenge based on what you've written, I think the challenge will be in the era of Trump, showing that companies still care about this, because stupidly the switch sort of turned in the other direction, right? Obviously there's regulatory pressure for this, I get it, but that would be sort of an important question. All right. And then last one here. I think getting paid for your development, the question is sort of how do you view startups using larger industrial partnerships as a way to finance development? Yeah, for sure. I mean, that's called revenue in my mind. And I think it's good. And I think it's smart. And especially with deep tech startups, we've seen a couple who, we've seen one robotics company just recently that were selling one of their components because they had this very unique component developed, and other companies thought it was quite valuable. And so it's basically it's 10% of their full system, but they just started selling this component to get revenue, to just start financing themselves. And I thought it was very smart and very well thought out. And that's, I mean, showing more and more traction, right? If you have big customers willing to pay you for co-developing your product, that validates that it's a huge problem for them and that they're willing to spend money on it, solving it. And so for me, I really like it. I think it's a very smart thing to do. And it sort of differentiates you against competitors who may have corporate partnerships that are unpaid, right? It's a bit of a like, yeah, they have nice logos, but maybe you have someone who's actually willing to give you money for the co-development. So I think that's part of it. All right. Other questions you have, topics you want to address, since there's nothing else in the chat that I can see. Maybe I missed something. I'm sorry. Maya, you just wrote, okay, do you as VC introduce your startups to new clients? Yeah, I think it's recently met a startup and at the end they asked us, okay, what's your value add as an investor? And my answer is investors don't add value. But that's sort of my honest opinion as a former founder. I think most VCs bullshit about how great they add value. For us, I think the honest answer is we've been in your shoes. We know how tough it is, and we try not to waste your time. And we see it as, if we are a shareholder, like it's this old school view of like, we're a shareholder, like we're in this together. And so obviously if we know someone that could be helpful to you, we'll make you that introduction. But I'm not going to oversell you on like, yeah, we have all these great people, and if we invest tomorrow, you have 10x your clients. Like, yeah, I mean, I think there's some cases where we're extremely helpful, but yeah, I think it's sort of important to you're the founder, you're running your company, you're doing all the hard work. And our ambition is that we know you well enough and your company well enough to ask you tough questions at the right moments and to challenge you when it comes about like the key decisions, like, are you hiring too many people? Are you hiring enough people? Should you let someone go on your team? Is someone of your C-level not performing? Is the product actually working? Do you actually have like product market fit or not? Like sort of digging a bit into those questions where maybe you already know the answer in your gut, but life is busy and you really don't want to look that closely now because it might be uncomfortable. I think that's our role, and it's for sure annoying sometimes for founders, but in the end, sort of it's about making sure the company is successful, and that's where we are aligned, and that's where we're trying to be. Yeah, not too close, but close enough. Sort of, I would call it, and I think that's every investor does it differently. I know lots of investors who actually are much further away from their companies, but yeah, for us it just doesn't feel right. Sebastian, if I grant VSOP shares to key positions, where do you see the biggest dangers of making the cap table uninvestable? I think VSOPs are actually fine. On almost every company, we have a discussion about the vesting schedule, because I find the market standard, which is 4 years vesting, 1 year cliff, I find that stupid. It's like value gets created over the long term. So for me, like minimum is like 2 year cliff, 5 year vesting, but that's not the market opinion. It's the Oyster Bay opinion. So if you do that, then VSOP is not a big risk because you have 2 year cliff. If someone doesn't work out after 18 months, they basically don't end up with VSOP. I think it's smart to protect yourself that way. And also with your co-founders, it's also smart to have longer cliffs and longer vesting schedules. So I think it's not an investor asking it. It's more like it's actually protecting the company if you have smart and better vesting schedule and cliffing. So yeah, for me, I haven't seen VSOPs make a company uninvestable, I would say, to answer that question. All right. And for CapEx heavy food tech, the ideal capital stack across the company's life is complex. Yes, agreed. Where do founders most often get this wrong? Stated otherwise, which type of funding do they more often move too late on? It's tough to generalize for me. I think the biggest mistake is getting actually VCs too early, in a sense, because what you have to think about, and what I think most founders don't have, and I mean, there's lots of more important things to have on your mind, but understanding like a VC fund life cycle, like a VC fund is 10 years, and the moment we invest, the clock starts ticking. And our current fund is a 2024 vintage, so it means it runs until 2034. So now we have 8 years left, right? And so if you're building something, and that's why we did a lot of, like, we invest across the whole food value chain, right? We can also do CPG products. We can do a lot of deep tech stuff. We did a lot of deep tech stuff early in the fund life cycle because of this. Because we said, okay, there's some deep tech stuff that it'll just take a long time. And we want that in our portfolio. And there's some great companies now being built, but it just needs time. And so we just need to invest early in our fund life cycle. And I think founders don't understand that fund life cycle and don't understand that match. And I think it's very important to be extremely critical on that. And actually, you asked the question earlier about reverse due diligence. That's another one I think not enough founders ask, like, where are you in a fund life cycle? Actually, I've seen rounds not happen because funds promised to close their fund and then they were not able to fundraise themselves. So I think that's also important to be quite critical. Have the VCs actually raise the money? Because right now a lot of VCs struggle to raise money, but they still need to show deal flow. So they're still speaking to a lot of founders, but they actually don't have the money. So I think that's quite important to actually just ask. It's an easy question, right? Where, like, have you closed your fund? When did you close it? What vintage is your fund on? How big is it in terms of closed amounts? I think those are very important questions to get this capital stack on the VC side, right? And then the grant side, I think, is extremely helpful in Europe. There's a whole bit, like, I personally actually don't like it in a way of like how many grants there are in the system, because I think it makes quite an inefficient capital market, but that's another discussion. But I think like from a company perspective, it's amazing. And there's lots of non-dilutive stuff out there. And being very smart about it is definitely quite important and helpful. And I've seen companies use it extremely well, where basically they skip 1 or 2 rounds because of it. One company in our portfolio basically tripled the money they raised with grants. And that obviously means like they don't need to raise for another like 3 years. Sort of just gives them a lot of comfort, and that's amazing. So I think, yeah, you can play that game quite well. That, and so I would say sort of strategic partnerships is the other one, where if you're actually solving a huge problem for some of these corporates, they will be willing to pay you for it. You just need to be bold enough to ask for it. I think a lot of founders are quite keen on getting the logo, and so they don't ask for like, hey, what is this worth actually to you if we solve it? And I think just asking that question quite early on is like, if we can actually solve this, what is this worth to your company? If you're one of the big ag companies or one of the big food companies, those numbers get quite big quickly. And then just asking for like, 20K, 50K development packages makes a huge difference for you, and probably for them, it's a rounding error, right? So it's like, that's something that's probably underused in a way, where founders maybe are not comfortable asking that question early enough, because they want to get the logo, they want to get the POC, and it's sort of obviously easier if it's not paid. Yeah. All right, how much do pre-seed actually raise? In the AI tech world, it feels like the amount they raise is just insane. I'm wrong, and it's quite normal numbers. Yeah, no, it's not normal numbers. It's for sure weird how much money is being raised right now if you push AI on your company. I think pre-seed, I would go by it by dilution. I think that's the only logic that makes sense, because it's sort of a question of what do you need to show to get to the next stage, in terms of like, what do you actually need to develop, and in terms of customer traction, in terms of revenue, in terms of product, how much money do you need to get there? Then double it and raise that. And then that's how I would tell you that. And then the dilution should be 10 to 20% at the most. And then that's your valuation and what you should raise. And then obviously in the end, the market will tell you if you're able to raise it or not. That's, I think, how it works. But yeah, for sure, be quite conservative, rather raise more. I think like actually raising $1 million is sometimes easier than raising 500K as a pre-seed in a way, because it opens doors up to other, like, we wouldn't look at a 500K pre-seed, but we'll probably look at $1 million pre-seed. So I think it sort of just opens up other investor profiles if you raise a bit bigger pre-seed. Also shows your ambition level in a way. So I think that's quite important, but your market needs to justify that investment and that valuation. So that's sort of the other side of the coin, I would say. Good. All right. I was going to say a couple more questions, and then I'd wrap up. Want to get some feedback in the end. I think the AI question is obviously fun, so I'll tackle it first. I think I'm super happy to be investing in food and ag right now. I think that's, we're very comfortable investing in this space because, yeah, let's just say I wouldn't want to have a software fund right now. So I think we're in this interesting point in time where now this Halo asset class is being promoted, right? You know, it's like hard assets, low obsolescence topic where all of a sudden hardware and deep tech is becoming interesting because people are realizing software is being commoditized. And so food and ag in this day of AI is actually becoming a super interesting asset class for a lot of people because what do you need? You need energy. That's sort of people realizing, okay, electricity, energy is, the need is there. And then the next thing is sort of food. Okay, people will need to eat. That's for sure not going to change. No matter what the AI agents are doing, we will still need to eat. And so I think building in food and ag right now is really, really interesting because of that. I think that will probably happen in 18 months or 2 years where like people will wake up and a lot of the AI agents will be 10 times better than they are today. And a lot of the other businesses will be commoditized and gone. And then I think our industry and some other like, you know, CapEx heavy, deep tech or like technical engineering heavy industries will be the ones remaining as interesting and investable. But yeah, I think that's super, super interesting. I think AI is, we're seeing it across our portfolio. Obviously, it's very, very, it means you need a lot less people to build a company. And that means you need a lot less funding, actually, if you do it right. So we have some companies in our portfolio that are just 2 people right now doing, we have one company in our portfolio that's 2 full-time employees doing probably 5 million revenue this year. And that probably wouldn't have been possible 5 years ago. And it's quite, they have some freelancers, right? Like it's not, sure, like there's some more people working, but not full-time employees. And I think that's very smart. I think that's a new and different way to build a company with AI that's possible now. I think that's, yeah, and that applies across different domains. We have some crop genetics, like Amatera in our portfolio is leveraging AI for crop genetics. We have harvesting robotics, obviously using AI for like image recognition of when to harvest and those kind of things. So the application layer is super relevant for food and it will only get better. But the problem of like, how do we build a resilient and well-working food system, that is only getting bigger and more important. And so I think that more and more capital will flock to it. I'm obviously very, very biased. Yeah, that's my view of it, I have to say. Yeah. Good. When farmer demand is already coming through word of mouth. Absolutely. Well, I have to say, like, if you have, the question is like, if you have the demand and you're raising money for acceleration and not because you need it, how do you show that? With the financial data showing that. And then that's the answer. Like it's just put the financial statement on the chart. And if it's a nice hockey stick going from left to right, every VC will fall over it. That's a very Pavlovian response to a chart that goes from the bottom left to the top right on a screen. And if it says actual, then that's even more interesting, but sometimes that doesn't matter. I think the response to the chart going from the bottom left to the top right is somehow trained into most VCs. Yeah. Right. I think this was good. I hope if there's anything else you wanna ask, shoot me an email. You all have my email. I'll try to answer it. Curious to hear if there's some feedback on this. Let's do quick round of feedback, and then I think we can leave it at that. Have a nice day, and thanks for joining. Take care. Bye-bye.